I think the shocker to a lot of people is we've entered here in 2025, and the Fed Atlanta's GDP Now indicator suggests that the first quarter will be down in terms of real GDP growth, down 3% at an annual rate from the fourth quarter to the first quarter. And that has unnerved a lot of people because the economy seemed to be doing fine. So now what I'd like to do is talk a little bit about why we probably are in the last phase of this rolling recession.
Cathie Wood predicts the U.S. economy is nearing the end of a rolling recession that began in 2022, driven by the Federal Reserve's interest rate hike. While recent data, including GDP contraction projections and rising layoffs, has caused concern, she believes this phase marks the final hurdle before a recovery. Wood emphasizes that productivity growth will play a pivotal role in driving GDP expansion while keeping inflation in check. She also highlights optimism surrounding fiscal policies, particularly tax cuts and deregulation. Wood sees retroactive tax reductions and increased government focus on supporting productivity as key drivers for economic growth, boosting consumer confidence and market performance. Despite concerns over tariffs and global trade, she remains confident in a bullish economic outlook. Wood envisions a transformative period marked by technological advancements and structural changes in the labor market. While fears about automation persist, she believes innovation will ultimately lead to economic expansion and a brighter future for the U.S. economy.
We've been talking about a rolling recession since the Fed started jacking up interest rates in 2022 for 3 years, a little more than 3 years now. We believe we've been in a rolling recession, and we're coming to the end of it. So that's the good news. The bad news is we do have to go through this process. Bottom line, however, we think after this initial shudder that the equity markets are going to look through whatever the next 6 months holds in terms of economic activity into a future where we see productivity driving real GDP growth at an accelerated rate in an exciting way. And at the same time, inflation continuing to come down because productivity is going up. Productivity is a powerful antidote to inflation. And we think we're probably on the threshold of some of the most important productivity gains in history. So just wanted to set the stage this way before we go on what is happening in these first 6 months of the year. As you know, there was a lot of hope coming out of the election that we were going to be on our way in terms of the equity markets' health and the broadening out of the equity market as a sign of its health. And it has begun, but as always, 2 steps forward, 1 step back. So let's talk about the 1 step back. In terms of fiscal policy, from our point of view, the most important proposal out there right now is the $4.5 trillion tax cut that did make it through the House. They passed a budget with a $4.5 trillion tax cut in it. And that's in addition to the $1.9 trillion tax cut that is part of the Tax Cut and Jobs Act, TCJA. That was scheduled to expire at the end of this year. And we don't think it will expire. This $4.5 trillion is on top of that. Now, you must be wondering what the heck is going on here. That just sounds like a bigger deficit, a bigger hole out there. Well, those numbers are over a 10-year period. But I think one of the most important things we're learning is that the tax rate cuts themselves will be retroactive to January 20th. Now, that's not cast in concrete at all, but we have heard in and around the administration talk of retroactive tax cuts. Why is that so important? Well, we learned from the Reagan Revolution that phasing in tax cuts is a recipe for a very deep recession, because people and businesses defer economic activity in order to capture the lower tax rates. And so I think this administration has learned from the Reagan administration that phasing in is not a good idea. So that is very important in terms of information. The Senate version of the budget is not out yet, and then we'll have to go through a reconciliation. I think what's so interesting about the way that President Trump has set this tax cut up is in terms of what people know is going to take place, and I think the president repeated it in his session to Congress this week. No taxes on tips, Social Security, or overtime. Now, those tax benefits are very appealing to the lower and middle class, which tends to benefit from those three sources of income. And so President Trump and team cannot be accused of favoring the rich. I think the other thing we're going to see here is that the threats and actual reality of tariffs, which is causing a lot of consternation. I do not like tariffs. They are tax increases. But I think that the president, and we'll get into this when we go through the charts again, the president is hearkening back to the early days of our country, where tariffs actually supported the government. The primary source of income for the government way back then was tariffs. And then, of course, today, tariffs account for very little funding of government spending, and income taxes account for most of it, business and consumer.
Cathie Wood believes the U.S. economy is nearing the end of a rolling recession caused by Federal Reserve rate hike. She sees signs of recovery driven by rising productivity, which can boost growth without triggering inflation. Wood highlights the role of fiscal policies, such as tax cuts and deregulation, in strengthening the economy. She expects these measures to restore confidence and support a robust rebound despite uncertainties in global trade.
Let's get back to the video.
So now what I'd like to do is talk a little bit about why we probably are in the last phase of this rolling recession. And it is Employment Friday. I'm not going to spend a lot of time on the January employment report. It's January. There's a lot of, the February employment report. There was a lot of bad weather, a lot of distortions. But if I can give you a few statistics from other reports that have come out recently on unemployment, the Challenger survey shows that layoffs are up more than 100% year over year. This is a very volatile series. But in terms of actual numbers, I think in February, the number was 172,000 layoffs. And if you look at in the context of history, pre or since COVID, that number was in the 50 to 60,000 per month range. So that's a tripling. And then just to compare it to other recessions historically, in 08 and 09 and also 01 and 02, we got to a peak in terms of layoffs of 240,000. So this is getting awfully close to those. In COVID, the peak was understandably 400,000. I don't think we'll get anywhere near there, but that 172,000 put in perspective to 08, 09, and 01, 02. That was the financial crisis and the tech and telecom bust. It says the layoffs are getting up there. We'll also see in the National Federation of Independent Business report next week an indicator showing renewed weakness in employment, where the small business sector has been extremely weak for the last 3 years and is relapsing after a little bit of excitement after the election. We saw the ADP report. It was subpar, 77,000. And the only other thing I'll point out from this report today, government in total did add 11,000 jobs. More than all of them were at the state and local part of the government sector. The federal government lost 10,000 jobs, and we think that number is going to mount considerably. If we're taking a step back and trying to figure out why consumer and business confidence is falling now again, it's because there is a lot of fear associated with this transition from one administration to the other, and some feeling of chaos, and that's the art of negotiation. So we're taking that as such right now. But if you look at all government employment, so federal employment is less than 2% of the employment in the United States, but federal, state, and local combined is closer to 25%. And then you have quasi-government in education and healthcare, and you're talking about a third of the labor force. And so a lot of people are probably wondering, is my job at risk, or is this move shifting spending from the federal sector down towards the states going to help me? So uncertainty certainly is the watchword. The reason education and healthcare are important is if you look over the last 12 months, those two sectors have been responsible for, I think it's 95% of employment creation, and that's a 12-month moving average, but 95%. In the early days of the last administration, those two sectors accounted for only 10% of job gains over a 12-month moving average period. So we're paying very careful attention. And then, of course, there is the concern that technology is going to take jobs. AI is becoming so proficient. We know coding jobs are the number is starting to go down. There are, I'm sure, a lot of entry-level positions that are not opening up because of artificial intelligence and other technologies. So there is a lot of fear on the employment.
Cathie Wood emphasizes that the U.S. economy is transitioning out of a rolling recession triggered by Federal Reserve rate hike. She points to rising productivity as a key driver of recovery, enabling economic growth without sparking inflation. Wood also highlights the importance of fiscal policies, such as tax cuts and deregulation, which she believes will boost confidence and set the stage for a stronger, more resilient economy despite ongoing global challenges. Looking forward, Wood remains optimistic about the economy's potential to rebound and innovate. She encourages focusing on long-term opportunities in areas like technology and productivity-enhancing industries. By leveraging policy reforms and innovation, she believes the U.S. can overcome challenges and foster sustainable growth. Do you agree with Cathie Wood's optimistic outlook on productivity driving economic recovery? How do you think fiscal policies, like tax cuts and deregulation, will impact long-term economic growth? Share your thoughts in the comments below.